This is not a drill. The Kenyan shilling is in freefall, and President William Ruto has just made the single most consequential economic intervention of his presidency. In a dramatic, high-stakes move that has sent shockwaves from the Nairobi Securities Exchange to the smallest market stall in Kibera, the government has announced a monumental plan to buy back a massive portion of its own debt. We're talking about 1 trillion shillings. That's 1,000 billion. But here's the shocking part: to do it, they're using money they don't technically have yet. This is a breathtaking financial gamble, with the future of every Kenyan citizen on the line. Will this bold move stabilize the currency and empower the economy, or will it plunge the nation into deeper fiscal crisis? Stay with us for the next 12 minutes for a deep dive you cannot afford to miss. To understand why this is so explosive, we need to rewind. Kenya's public debt has been a ticking time bomb for years. As of last month, the total public debt stood at a staggering 11.14 trillion Kenyan shillings. That's approximately 70% of our gross domestic product. A huge portion of this, about 3.6 trillion shillings, is domestic debt, money owed to local banks, pension funds like the NSSF, insurance companies, and even individual Kenyans who hold treasury bonds. Servicing this debt is crippling. In the current financial year, a colossal 1.53 trillion shillings was allocated just to pay interest and principal. That's money not spent on healthcare, roads, or education. The shilling has borne the brunt of this pressure. Over the past 3 years, it has depreciated dramatically against the US dollar, losing over 30% of its value. A weak shilling makes everything imported, fuel, medicine, machinery, wheat, catastrophically more expensive, fueling the high cost of living that has sparked nationwide protests. The government has been trapped in a vicious cycle. It needs shillings to pay domestic debt, but issuing more bonds to raise those shillings increases the money supply, which can further weaken the currency. Enter President Ruto's administration with a radical proposal. The plan, announced by the National Treasury, is to conduct a domestic debt buyback of up to 1 trillion shillings. But the mechanism is where it gets controversial. They intend to use new loans. Specifically, they plan to tap into yet to be disbursed portions of existing external loans from multilateral institutions like the World Bank and the International Monetary Fund. They're essentially using future foreign debt to pay off present local debt. This strategy is unprecedented in scale for Kenya and places an enormous bet on complex international finance. Let's break down the core facts. The announcement came directly from the National Treasury Cabinet Secretary, Professor Njuguna Ndung'u. The target is securities held by domestic investors that are maturing within the next 4 years, between 2024 and 2028. The government will approach these holders, primarily commercial banks, which hold about 54% of domestic debt, and offer to buy back their bonds before they mature. But they won't pay in cash from existing reserves. Instead, the Treasury plans to utilize committed but undrawn external financing from multilateral development banks. In simpler terms, they have credit lines from institutions like the World Bank that they haven't used yet. They will draw down on these lines, receive US dollars, convert those dollars to shillings on the market, and then use those shillings to pay Kenyan bondholders. The immediate official goal is twofold. First, and most critically, to stabilize the Kenyan shilling. By injecting foreign exchange into the market through this conversion, they aim to increase dollar supply, which should theoretically strengthen the shilling. A stronger shilling would immediately lower the cost of imports, particularly fuel, potentially bringing down electricity and transport costs. Second, to manage the maturity profile of the debt. By buying back short-term debt, they can potentially reissue new debt with longer maturity periods, kicking the repayment can further down the road and easing short-term fiscal pressure. Professor Ndung'u framed this as a liability management operation, crucial for creating fiscal space and addressing liquidity pressures in the money market. Key statistics underscore the urgency. Domestic debt redemptions, the money needed to pay back these local bonds, are peaking. In the current fiscal year ending June 2024, the government needs 390 billion shillings. Next year, it balloons to 510 billion. The year after, 2025-2026, it hits a wall of 670 billion shillings. This buyback is an attempt to smooth out this terrifying redemption wall. Furthermore, the Central Bank of Kenya has been burning through foreign exchange reserves to defend the shilling, with reserves dipping close to the critical 4 months of import cover threshold. This plan is a direct attempt to rebuild those reserves without further depleting them. However, this plan is far from universally applauded, and the opposition and economic analysts have raised profound, alarming questions. The most glaring perspective is that this is not debt reduction, it is debt substitution. Kenya's total debt stock of 11.14 trillion shillings does not decrease by a single cent. It simply changes form. Shilling-denominated debt owed to Kenyans is potentially replaced with dollar-denominated debt owed to foreign institutions. This swaps a domestic problem for a potentially more dangerous external one. Why is that dangerous? Debt in foreign currency carries a severe exchange rate risk. If the shilling weakens again in the future, which is a persistent risk, the cost of repaying those dollar loans skyrockets in shilling terms. We are essentially betting that the shilling will strengthen and stay strong permanently. It's a huge gamble. Opposition leaders like Opiyo Wandayi have labeled the move a sophisticated Ponzi scheme, arguing it creates an illusion of stability while mortgaging the country's future. They question the transparency of the process, which specific external loans will be tapped, at what interest rates. The terms of multilateral loans are often non-negotiable and can come with stringent policy conditions. The reaction from the financial markets has been mixed and cautious. Initially, the shilling strengthened slightly on the news, a sign of short-term market optimism. However, banking analysts are deeply concerned. Commercial banks are the biggest holders of government paper. These bonds are prime, liquid assets on their balance sheets. A forced or large-scale buyback could destabilize the banking sector, affecting their liquidity and ability to lend to the private sector. It could crowd out businesses and individuals seeking loans, potentially slowing economic growth. Furthermore, pension funds, which manage the retirement savings of millions of Kenyans, rely on the predictable interest from government bonds. Disrupting this income stream could jeopardize future pension payouts. The international perspective, particularly from credit rating agencies like Moody's and Fitch, is one of watchful skepticism. They will be scrutinizing whether this operation genuinely improves Kenya's debt sustainability or merely rearranges the deck chairs on a fiscal Titanic. Now, let's translate this high finance into everyday life for ordinary Kenyans. The immediate hoped-for impact is a stronger shilling. If it works, you could see it at the pump within weeks. Petrol prices could drop. The cost of imported maize flour and cooking oil could ease. The price of a new vehicle or spare parts for your matatu could become slightly less prohibitive. For businesses that import raw materials from manufacturers to bakers, input costs would fall, which could, in time, lead to lower prices for consumers. It could provide a desperately needed breather from the suffocating cost of living. But the if it works is a monumental condition. The negative consequences if this gamble fails are severe. First, if the shilling fails to hold its gains, we are left with more expensive foreign debt. This means even more of your taxes, potentially trillions of shillings over the coming decades, will be sent overseas to service loans instead of building local clinics and schools. It directly reduces the money available for county allocations and national development projects. Second, the potential disruption to banks and pension funds hits home. If banks become unstable or restrictive with credit, getting a business loan, a mortgage, or even a personal loan becomes harder and more expensive. If pension fund returns suffer, the security of your retirement is undermined. Socially and politically, this is a powder keg. The Ruto administration is staking its economic credibility on this single, complex operation. If it succeeds, it could be hailed as a masterstroke, empowering the government's bottom-up agenda by finally creating fiscal space for investment. If it fails and the shilling collapses further, the resulting hyperinflation could trigger social unrest far beyond the protests we have already witnessed. The political ramifications would be immediate and severe, eroding trust not just in the government, but in the very institutions managing the economy. What happens next is a tense waiting game. The Treasury must now operationalize the plan, identify the specific external loans, and begin the buyback offers. Every movement of the shilling against the dollar will be headline news. Parliament will demand oversight hearings. The central bank will be under immense pressure to manage the resulting monetary policy shifts. So, what are the experts saying? The consensus among independent economists is one of extreme caution. Dr. Xen Iraki, a noted economist at the University of Nairobi, calls it a high-risk, high-reward strategy. He notes that while liability management is a standard tool, the scale and funding mechanism are unorthodox and carry significant execution risk. He warns that the success hinges entirely on two volatile factors: the continued flow of external financing and the behavior of the foreign exchange market, which is influenced by global factors beyond Kenya's control. Financial analyst Ali Khan Sachu describes it as a Hail Mary pass in the final minutes of an economic game. He compares it to similar debt swaps attempted in other emerging markets, like Ghana and Zambia, which provided temporary relief but ultimately failed to prevent deeper crises because they did not address fundamental issues like unsustainable spending and low revenue collection. The critical difference, he points out, is that those nations often swapped commercial debt. Kenya is proposing to swap relatively cheaper domestic debt for potentially more rigid multilateral debt. The predictions are bifurcated. The optimistic forecast suggests a temporary shilling rally, a slight reduction in domestic interest rates, and a window of 12-18 months of breathing room for the Treasury to implement serious fiscal consolidation and growth-stimulating reforms. The pessimistic, and many argue more likely, forecast is that the shilling strength will be short-lived, the underlying structural problems will remain unaddressed, and Kenya will find itself in 2026 with a higher external debt burden, facing the same redemption pressures but with fewer policy tools left in the box. The ultimate expert insight is clear: this buyback is not a solution. It is a costly, temporary bridge. What is built on the other side of that bridge, either fiscal discipline and export growth or continued deficit spending, will determine Kenya's economic fate for a generation. The key takeaway is this: President Ruto's government has placed a 1 trillion shilling bet on the Kenyan shilling. It is a desperate attempt to break a vicious cycle, but it risks creating a new, more dangerous one. Watch the exchange rates daily. Watch for the details of the external loans used. Watch the reaction of the banking sector. This story will define Kenya's economic trajectory for years to come. For continuous, in-depth coverage of this and every major story impacting our nation, subscribe to Kenya News Update today for more breaking news.